Hello and welcome to the latest instalment of MFS's Let's Talk Property podcast, where we connect with industry experts to explore an array of topics within the dynamic world of property. Before we dive into today's episode, I want to take a moment to share a quick disclaimer. MFS are a bridging loan and buy-to-let mortgage provider and are not financial advisors. The opinions and views expressed in this episode are personal to the host and guest and may not reflect the views of MFS. For more information on MFS, you can find us at www.mfsuk.com. Be sure to keep up with our podcast updates on Instagram at MFS_LTP. Now, let's get started. Hello, and welcome to the Let's Talk Property with MFS podcast. My name is Leah Brunskill, I'm the head of marketing at MFS, and I'm making my podcast debut today to bring some really exciting news from Mike Cook, who is here with us, back on the podcast after a while. Here to talk about the new product which launched earlier this week. Can you tell us all about it?
Well, I can. We're doing a few things, which is great. We've saved them up. So we go out in June with something that's good for everybody, and I think that's the key thing. There's something for everybody. We've got a really large broker base. We've got 3 dedicated underwriting teams, and there's something for all of them, which is great. I think the main thing we're doing is something called Fusion, which is taking the best bits of a bridge and incorporating some of the pieces of what's really good about buy-to-let. And these are loans for up to 20 million, so they're chunky. And so this is ideal if you think about where our buy-to-let range is on commercial, go up to 1.5 million, residential go up to 3, this will go up to 20. It's particularly targeted at the commercial, larger ticket properties. And what this will give you is a bit of certainty, so it'll be a 2-year term on a tracker. And trackers are kind of attractive right now, and they are more attractive on bigger commercial properties as well, because with the future projection being in a downward basis, it's ideal. And we'll also permit a 1-year extension subject to certain conditions. So it is great in the name, and it will bridge the gap between finance today and what will be around in 2 years' time. And the idea being is that it's very light on things like interest coverage ratio. So in other words, where buy-to-let is fairly strict, all we'll be looking for is that people can afford the repayments. You can roll up interest, which we do on our bridging today, but you can also defer interest, which we don't permit on bridging today. It's very much a buy-to-let thing. And that's great for cash flow. So if, for example, you take 2% off your rate for 2 years, you pay us that back at the end. Mm-hmm. And what that allows is additional leverage, which is great. So you can borrow more on that particular property. And so the great thing for us is that you can take those features, you can apply them onto a bridging loan, and it's cheaper, it's longer term, but it's cheaper than our standard bridging as well. Mm-hmm. So it'll start to make people think about, well, actually, what's the best fit? We want people to stay a little bit longer on this product. So the idea being is that it's a good suitability product for those in the commercial space looking for something to cover them for 18 months, 2 years, maybe even 3 years, until they can sort longer term finance out.
Okay, so you mentioned a couple of things there about why the market needs it now, the downward trajectory and all those things. Is there anything else that brought this product together? Where did it come from?
Well, I think one of the key things for us is we would like to do more commercial. We have many funding lines, and some of them we've been working with to say, actually, we do an awful lot of residential. We're good at commercial. We want to do more of it. And so actually we wanted to do more of the bigger ticket as well. Mm-hmm. And there's demand. And I think if you look at the market, in the commercial real estate market in the UK, there's about 170 billion of debt outstanding on commercial property. The Bayes report, they do a really in detailed report every year, and they estimate there's about 59 billion expected to refinance this year. So if you imagine, they would have taken that out when rates were lower. And if you think about the typical places they go for these large ticket loans, they tend to be lower LTV with private banks, whoever their corporate banking partner is, and those sort of things. If you're a corporate sort of borrower, that stuff takes a long time to sort out.
Yeah.
The problem is that if all of a sudden you're at a point now where you go, well, the bank I usually use won't go to the LTV I need, will go up to 75% on residential, 70 on commercial. A lot of banks aren't going with above 50-55 LTV. So we can provide a solution for them that'll give them time to sort out their longer term finances without all the rigmarole of the normal application processes that you'd have to go through. And so on the back of that as well, we're also improving our commercial buy-to-let range, our term product. So we've been piloting it for a while, and these are loans up to 1.5 million, really flexible. Leverage is great because you can roll and defer interest. We've been restricting it for a while. We've been taking the feedback, we've been amending it. And one of the things was around property types. So one of the key things we're doing, not only do we make it sharper on rate, we're going down by about 0.3% on the commercial rates to make it a little bit sharper. You, thankfully, in marketing will be you're putting it on the website, and we'll be adding other things so that it's more visible. And I think one of the great things here is that the property types will be expanding to include things like hotels, B&Bs, sort of care homes, school-type buildings. So all these different things that we get asked for, sort of clubs, memberships, gyms type things. And so, again, we'll be able to do a lot more in this area, and we've got a lot more to come in commercial as well. So within the next hopefully within the next month or two, watch this space, because there'll be more to come there, and there'll be more to keep everybody really busy, which is fantastic. And I think the final thing, which is the bread and butter of MFS, is bridging. So we're going to be cutting the rates on bridging by about sort of 10, 11 basis points, which is about 1.3% per annum. We've been doing really well on bridging. It is our core product, and it's time to reflect that conditions are a little bit more settled. So therefore now we can go a little bit harder, and we can respond to feedback and just be that little bit sharper for everybody.
Nice, okay. With the usual bespoke underwriting from day one, all of that good stuff that we talk about from and all those things.
Let the underwriters seriously earn their corn over the next few weeks. I think they've been busy and they're great. And we have 3 large teams, 2 focus mainly on bridging, 1 team on buy-to-let. And I think what we're hoping to do is it's all manageable, it's all scalable. We've been putting in technology in the last few months, and it's all about being in a controlled growth phase. And that's what's great about it, is you take what you can process. Nobody likes particularly slow lenders. We introduced title insurance recently, and so far it's been phenomenal. The first cases actually were ready to complete within 15 days of instructing the solicitor, and actually we found the delays being more that the customer solicitor's on holiday. And you're like, we're ready to go. So I think we're trying to lighten the load of everybody, and so those guys will be really busy. And like I said, Leah, it's the day one underwrite. It's kind of our thing. It's more work, because not every decision in principle that's credit backed will go on to apply, but we'll do the work up front. So when we say, yes, here's credit, it means yes. We'll do the valuation, subject to some final checks, KYC, anti-money laundering, so forth, that you'd expect a prudent lender to do. But that's not a problem. And so it will go through, absolutely.
And we've still got the val refund going, right? So
we've got another month on standard bridging for that. So what we'd ask for is get your dips in by the end of June and complete a month later, and get your valuation refunded. We're cautious and we say within 28 days. The vast majority actually go day after the second day. We just need to know the bank account that it's been refunded to. And ironically, that's the biggest delay. You would have thought people would want their bonus. Yeah, that's right. There you go. But don't give us yours. But
no, for sure. Okay, cool. So exciting stuff. So information on the new products, obviously all on the website. We've also got the comparison table now, which is something that we haven't didn't have previously. So people can go on, have a look at like the core range, as in the bridging range, the fusion range, the buy-to-let range, and commercial buy-to-let, and kind of see the features of all. So they're all on the website now, so you can go and have a look at those. The guides are all updated, they're all on there as well. But obviously we have got live chat, and it's really easy to get in touch. So people can kind of go on there, and if you've got any questions, do reach out in the live chat. That is actually directly to an underwriter, so when you're on the live chat, you are talking to an underwriter, so you go on there and ask any questions that you've got about the whole range of products. So another thing I wanted to just talk about was the election. Obviously, we've not spoken about it too much yet. We had a couple of things go out on the website of what it could mean and things like that. What are your views? Is it going to affect us? How's it going to affect us?
Well, all these things do. One of my frustrations at the weekend of looking through a variety of the titles, and one of my big frustrations, they're all talking about these big issues, like here's the big 7 issues. Housing wasn't one of them. That really frustrates me because that's the feeling I've had in government for the last 20 years, which is surely a roof over your head is equally as important as health, education, defence, the economy. And we know it's an emotive subject, but we've had this double prong of house prices keep rising. Rents have risen significantly, 10-11% in the last year in places like London, even higher in Scotland, and I'll come on to that in a minute. The big problem we've got is, for years, there's been a fundamental lack of new houses.
Yep.
So population keeps increasing, immigration increases the population as well. Where do people live? And so competition for houses increases, prices go up. It's like any market.
Yeah.
Problem you have is back in 2014, mortgage regulation increased, and there was start of talking about saying, well, okay, landlords are competing with first-time buyers, and therefore pricing going up. Not really. If you're going to buy a property to invest in, you want something that gets you a good yield, and a one-bedroom flat, studio flat, is not what gets you a good yield. So I think they became an easy target.
Sure.
And they've continued that way. And landlord bashing has almost become a national sport.
Yeah.
But it's actually counterproductive. And both parties seem to want to win votes, and it's popular. Now, a great example last week is the Renters Reform Bill. Mm-hmm. Okay, so there's some really good things in there for tenants and for landlords, and we all want a good market, good properties, good quality tenants that respect the property, but ultimately it's a private landlord and it's their property, and they deserve to be paid, and if somebody doesn't pay, they deserve to replace them with somebody who can pay.
Yeah.
Now, what happens is interest rates have risen in the last year. They were also bashed with having to improve EPC, or the threat of, but inflation sent the cost estimate of $5,000 per property through the roof, and they decided that's not feasible. Yeah. Landlords will just exit in their droves. What you've got now is the government's own research actually stopped it pretty much in the House of Lords, its Renters Reform Bill. Because what they said is 45% of all the guys that go to their council to say, I'm going to be homeless because my landlord is selling the property, is the single biggest reason. And the landlord's had enough, they're making a loss. Yeah. And they don't deserve to make a loss. And so at the end of the day, they aren't a charity, and they do it to, you might as well sell the property, put it in a savings account and get 5%, rather than get minus 3% being a landlord and have all the hassle and not be able to. So there comes a point where they finally realise, and even Generation Rent and other sort of lobbyist groups suddenly went, actually, yes, landlords leaving the sector is the single biggest challenge we have.
Yeah, and actually that's not a good thing, as much as we...
Maybe we bash them too much. So, and there's times like this I find really frustrating, is all you can do is appreciate that interest rates have gone up, their mortgages have shot through the roof. Therefore, not a lot, but some have left the sector, meaning there's less properties. People will pay more, and also slumlords who have no place in the market anyway, and thankfully they are a minority, don't have to do anything, and their property gets taken. Yeah. You're like, what good looks like is a healthy market where there's lots of choice. Landlords have to compete for tenants, and they compete through cheaper rent, better quality, better facilities. The so-called slumlords also have to work hard, and they have to improve their property to attract people in, and be attentive and fix things when they go wrong, or when the tenant wants to change something. Great, be responsive, and that's what a good market looks like. So all I would say is, please, political parties, start talking about it. You could start reducing the tax burden right now so that they very quick fix. So suddenly landlords stop moving out of the sector and moving into things like commercial or other things, or savings accounts, where it can be more lucrative, and that's not right. So I think have a look at the parties, but I'm afraid they both seem to be promising the same thing. One is saying, sorry, there's two parties, it sticks in your mind. One saying we'll build 1.5 million homes in the next Parliament. The other was said we'll do 300,000 a year. Parliament lasts about 5 years at the same number, but one sounds bigger than the other. And nobody's ever delivered 300,000 a year. No. So, specialist lenders, converting properties into flats is much quicker than building estates. So, luckily, this is a big growth area. It's much more efficient for a developer to go, let's take a pre-pandemic office that's not needed anymore, get quick planning permission, convert it, use short-term finance to do it, bridging, fusion products, and all of a sudden you've got a quicker way to get houses to the market.
And also then regeneration of spaces not being used, which leads to better town centres and all that stuff, which is, good for local areas.
Thriving. We lent on last year a shopping centre, a former shopping centre. And actually it made some lovely luxury flats and some smaller affordable flats, a good mix of properties with a nice lovely atrium and facilities, gym on site and everything else. Fantastic. And it was a disused shopping centre. So why not?
Exactly. Nice, okay. So lenders, obviously we like to think that we're making changes for the good of the market and providing products that people need. What else do you think that lenders can do to kind of help move things along? Do you think there's any other gaps that need filling that we don't deal with? Or?
Well, I think ground-up development's going to be in demand, which is not something, it's not a specialism of ours. But it's something that is very important. Compared to Europe, we do very little self-build in this country. It's very normal and very easy in most of Europe to find a plot of land, apply, pretty much get things done. I think there's work going on about the speed of transactions as well. Again, we have a very diverse international staff base at MFS, and it's fascinating talking about their own experiences at home compared to the UK, where, for example, you can go to your town hall, get all of the searches, the planning, consent, everything needed, hand it to your surveyor, and you can take it back 2 days later. And it takes months here. It's crazy. But I think there's going to be a lot of need for development. I think there's going to be a lot of need for conversion. But I think it's for the industry to talk it up as well, because it does get a bashing. Landlords have had a bashing, lenders have had a bashing. Oh no, the big lenders have put their interest rates up again. Well, it's because they're making minimum margins, and if the cost of funds goes up, it's almost like their rates have to move with it, and that's just it's good that they're down to sort of minimum margins, but it's not great for their shareholders all the time. But they're trying to do their best. But we really need to be in with the government, in with the Bank of England, the trade bodies, trade associations, really saying, look, enough's enough. The economy has stagnated. We want it to grow because it benefits everybody. Housing transactions, we should be all over this. It's the same as stamp duty and downsizing. It's like we should be encouraging people to downsize for free. It frees up a bigger house. It allows people to move up the ladder, frees up small properties for first-time buyers. It creates jobs for all sorts of tradespeople, estate agents, removal people, you name it. It's there and it grows an economy. So please, again, it's the thing to the politics. Just get markets moving, but the taxman, I think, has too much of a say.
Yeah, for sure. I expect a lot of people agree with you on that as well.
Well, yes, because they say, well, no, we're losing that. And you're like, yes, but you're gaining it elsewhere. I mean, I could rant all day about various things, as you know. I walk around the office having a rant about various things. But I also think there's challenges with councils around, there's other pressures on the private rented sector as well. And we've seen evidence of this where Councils are putting up people in hotels and things as temporary accommodation, whether they be immigrants awaiting decisions or other things. And they've kind of almost been threatened with some of their funding, is that they've got to stop doing that because it's too expensive. So where are they going to put them? Because a lot of the social houses are sold off. And Labour traditionally have been ones for building them, and Tories have light aspiration of home buying and selling them off. So you're always going to get a flux on that one. But again, so they're going to be put in the private rented sector. The government seems to like build to rent, which is for big pension funds. They built these big luxury apartments. You can see them in East London, by Wembley. But that's not what's needed. These are luxury places with big balconies and things. It's like, that's not solving a housing crisis.
No, for sure.
Well, that's right. And so if you get huge pension funds, always used to buy big corporate property and let it out and get a return and create it as part of a fund that pensions invest in. Fantastic. But the government really wanted them to take the slack on. They've shown really in the past they're not that keen on the private landlord, and they prefer to do corporate, but the corporates want a really big yield, a big return on their investment. They're only going to do that with luxury places that the wealthier want to rent and will rent off them and pay a very good yield and pay a very big service charge to pay for the concierge and the gym and the pool and all the rest of it. Fantastic, but that's not really what's needed.
No, sadly not. Okay, amazing. Anything else you would like to say about the new products?
No, I think have a look. I think it's going to be good. I think the BDM is going to be incredibly busy. They're the first point of contact for most brokers because it's easier. And I always like to think it's fairly old school in that they'll just pick up the phone and go, I've got this situation, am I better on Fusion, on Bridge, or on a buy-to-let? And I think it is all down to the circumstances, but the great thing is the calculators online can get you an emailed indicative really, really quickly, really easily. We can use the different leverage. The underwriters and the BDMs have different tools to find the optimum loan size for people if maximum lending's what's there. But I think the new rates will be really popular. The lower, I think they'll find hit the right spot with a lot of our broker base. And new brokers, of course, and a lot of our inquiries are from new brokers, which is always great. And so, yes, I think the Fusion is pretty exciting. And I think that we call it something really boring. And the nice thing is you guys, your marketing team, just sort of give it a nice feel as to where it fits in between Bridge, buy-to-let. We hope it's pretty clear, and it has great success.
Okay, great. And just have to mention as well before we go that you are talking at one of our events on the 13th of June, which is approaching affordability. I think we've still got some spaces, so do have a look at that, and we'll be talking more about affordability in the market and also how we deal with that in terms of leveraging the loan sizes and all that sort of stuff. So do go and check out that on the website, and you can sign up there. But thank you so much for coming on again.
Thank you.
Your little hiatus. And I'm sure we'll get you on again soon. Thank you
Excellent.
so much.
Thank you, Leah.
So this has been the Let's Talk Property with MFS podcast. You can subscribe and like and share online. And if you need any more information, please visit the website, go on to live chat, have a look at the rate tables, download the Bridge and the buy-to-let guides, and give us a call. Thanks very much. If you enjoyed this episode, don't forget to subscribe, like and share. You can access our previous episodes in all the usual places, as well as on our website at mfsuk.com/podcast. You can also stay connected with us on Instagram at mfs_LTP. See you next time.